Here to share where she's finding opportunity now, Avery Sheffield, co-founder and CIO of VantageRock. Welcome back.
Good to be here.
Let me get your view, though, of this market. What's going on here over these last couple of days post Jay Powell? Are we getting it right, as I asked Gabrielle as well?
I'm not sure the market is actually getting it right. I don't think Powell would say that the market's getting it right. I feel like he was really trying to present as hawkish message as he could, given that the economy is starting to show signs of slowing.
Really? I mean, he had multiple opportunities yesterday to push back on the market's view of, future hikes, and he really didn't do that. The market's priced him out.
Yes.
He had that chance. He didn't do it.
Well, I don't think he thinks, given the way things are going right now, that there need to be future hikes. But the market's reaction has almost moved from future hikes to near-term cuts, right? The market has gone into this still being expensive relative to treasuries. And so if you think that there just aren't going to be cuts and you're going to have the Fed funds rate over 5%, the 10-year, close to 5%, many stocks are far too expensive. And the movements since he started speaking suggest that they're starting to price in some real rate cuts.
So you agree with Jeffrey Gundlach then that now's the time to buy bonds? You're going to have a bond rally?
I don't know. This could be a head fake. I don't know that rates need to go that much higher. So it might be a fine place to be, because over time, especially like the short end of the curve over time will come down. But how long is that from now? Who knows? On the short end of the curve. The long end of the curve is, really a question of how long can can Yellen stave off, more treasury issuance, what happens internationally. So this move right here, given that we aren't going to have a surprise in treasury issuance, might be okay, but it also might be a head fake. I mean, what happens tomorrow if the jobs data is strong?
Yeah, well, I mean, good news has been greeted with bad news and vice versa. And you think we're at risk of that again? I think we're at risk of that. And actually, I think there's a very reflexive dynamic in the market, right? Whenever there's bad news, the market rallies, bond yields come in. That's stimulative. That's a key part of the financial conditions that Powell was speaking about. Like, if financial conditions loosen, they loosen for him. He's going to keep rates higher. As long as rates are higher, things are going to slow. What that might mean is that we're in a more range-bound kind of potentially grind down on stocks that are too expensive dynamic. Which stocks do you say are too expensive?
Which do I say? Well, I mean, the way we look at things is the way many investors are today, is if cash is at 5%, you want an earnings yield that's greater than 5%. You want a PE that's lower than 20, right? The market's right around there. And so we think...
Well, only because of mega caps.
Not just because of mega caps. I mean, there are still a lot of growthy stocks out there that are much more expensive than the mega caps. And I think people are still measuring those stocks on incrementality towards potentially making money, but they're still nowhere close to their valuations. I think as the economy probably does continue to slow, unless, again, we have so much stimulation from the market that things move up again, those companies might have a harder time growing into their valuations.
So you're telling me you want to stay, it sounds like you want to stay away from the Nasdaq.
Not all of the Nasdaq, but you want to be careful about stocks, I think, that are still much more expensive than a treasury yield, unless there's very significant growth in addition to that strong earnings yield.
Well, like the ARC type stocks are the ones with the higher valuation. The mega caps have all are, well, not all, but most are above 20.
Yes,
PE, maybe Alphabet and Meta are below, but they're still elevated. The other ones are. Yes.
So that's right. So with the kind of the Magnificent Seven, there's certainly a dispersion of valuation in there. The less expensive stocks in the Magnificent Seven certainly could grow into their valuations. You have Microsoft, where if Copilot goes really well, will certainly grow into its valuation. So what we're looking at is like which stocks could potentially grow into that kind of 20 times PE or lower over the next 1 to 2 years. A few of those names, I think, potentially really fit into that category. But it's more like the ARC stocks that are still very growthy, very frothy, some with very still questionable balance sheets. The earnings that I would be more concerned about.
Let me get your opinion on what Bill Gross said today. He tweeted, we're going to show you the tweet, essentially calling the bottom. In regional banks, says buying Truist, Citizens, KeyCorp, the falling knife of regional banks has now hit a bottom. By the way, he's going to be on Last Call tonight. It's an exclusive interview with Brian. You'll want to pay attention to that, 7 o'clock Eastern time. Your thoughts?
Yes, I think he might be right on the regional banks. And it's not because they're about to turn tomorrow, again, if we have this dicey economy, but there's so much negativity that's priced in. And given that we're likely to have kind of an up and down economy, but not that could keep a major credit event from happening. If you don't have a major credit event happening, the regional banks are far too cheap, and they don't have the same regulatory pressures with the very significant capital constraints that are being put on the larger banks. So I do think it's a place to watch. But look, if we have a bond rally today, they're going to work really well in bond rallies. That goes the other way. You could certainly feel some pain in the near term.